The broadcast is now starting. All attendees are in listen-only mode.
Well, hello everyone. This is Ron Kresha from Golden Shovel Agency, and I want to welcome everyone that we have so far. It looks like so far we have 22 attendees. We had 40 signed up, so we'll have a number of people probably still join in the next couple minutes. But I want to thank everyone for being here, and I certainly want to thank our presenter today, Paul Sharon from Impact Data Source. And I'm not going to spend a lot of time here. I want Paul to get right into it. But if you're familiar with the GoTo software, you do have the ability to submit questions. And if you submit those questions, Victor, who is our leader on this, and Victor, if you just want to say hi real quick.
Hi, good morning. Please feel free to type in any questions in your questions dashboard. We'll be happy to answer those after the presentation.
Okay, and so he's our behind the scenes technician guy, so he'll make sure all that gets filtered to Paul. So with that, other than Paul, I just again thank you for agreeing to do this. Our webinars are very important to what we offer to the people in the Golden Shovel family, and I'm going to turn this over to you and let you take it from here. So with that, welcome.
Thanks so much, Ron. I really appreciate it, and thanks, Victor, for all your help here today too. And thanks to everyone kind of tuning in on this topic. I appreciate the interest here. What I'm going to talk about is as I say it here, the 7 things that your board or your city council needs to know about that cost-benefit report. And so what I'm talking about here is from economic developers. Most often have a board or maybe a city council that they're communicating with, or county commissioners, and just thinking about when you present one of these economic impact reports or cost benefit reports, as it may be called, what are the important things that they need to know about that report. So just a little bit of background on me and my company. Source is a consulting firm based in Austin, Texas. Many of you may be familiar with my partner, Jerry Walker, who founded the business more than 20 years ago. And so in that time, we've got quite a bit of experience evaluating economic development the impact of economic development projects for communities and businesses across the country. Currently, we license, so we work a couple different ways. So one thing is we license models to clients where they can run the reports, impact reports or cost benefit reports throughout the year, as many reports as they want to run. And so we put together a software that they can use, and we have about 70 of those economic development organizations, and that includes cities, states, and counties, and so forth. And then we also do reports on just an individual basis. So we kind of do it 2 ways, whether if you just want some software and you're good to go, or if you just want to say, hey, I just need one report, can you help us out in this one case? We do that as well, that consulting. Just one other thing here on this about Impact Data Source, we have 2 podcasts that are actually probably of interest, hopefully, of a lot of economic developers. The first one is called Economic Development Secrets. And in that case, we talk to economic developers from across the country, 1 person per episode, and just kind of hear some of the exciting things that are going on in their community. And very often that is a specific deal, and kind of walking through kind of how everything came together with that one particular project in their community. And then the other podcast that we have is 123 CECD, and that's for anyone kind of working toward or even having obtained these certified economic developer certification or designation, and just kind of the ins and outs of that whole process, and kind of some encouragement and motivation kind of along the way. Now let's get back to this idea of cost benefit reports. And in our experience, and kind of as we've worked with our clients, we see that they can be extremely valuable for economic development decision making, and to keep everyone on the same page. And by that we mean to help the economic developer put some quantitative numbers behind what they're presenting to elected officials or appointed officials and other stakeholders. And so one of the things that we've seen over time is that there's a lot of confusion around these cost benefit reports, and it's really not that surprising, because there's no standard terminology and there's no standard presentation or table layout for these cost-benefit reports. And so everything, unless you have a set process in place that you're using, or a set template that you're going to use, or maybe a certain provider that's producing these reports and that you're familiar with, really, when you ask for someone to do a cost-benefit report, or an economic impact report, as sometimes it's called, really, who knows what it could look like. It could be 1 page, it could be 20 pages, it could be 50 pages, and the terminology and the language within that could vary quite significantly. And so again, it's the fact that there is no standard leads to this being somewhat confusing and ultimately being misinterpreted many times. Overall, a lot of these things, it's using some economic impact jargon, and so it can be intimidating and it can be opaque. And so we want to try to talk through some of those things today and try to get our heads wrapped around and try to help you understand what are some of those terms. And if you see a term called, say, household earnings or something like that, what are they actually talking about, and what is that equivalent to if you see another report where maybe they say some other term. And then ultimately, what we're going to be walking through with these 7 items are what are the hallmarks of a high quality cost benefit report. And everyone's seen the cost benefit report that you just look at and you already know it doesn't make sense, or that it doesn't seem to ring true, and that something just seems off about it. And so I've prepared these 7 things, and I actually put a blog post out, I think it's on LinkedIn, where I kind of wrote up in detail some of this information and kind of cite back to some other longer things that we've written in these things. But I think this is a good format for a presentation about the topic. So the first thing of our 7 things that a board needs to know about cost benefit reports is that the report really needs to focus on your region. And so as we dig into that, if you are a local ED organization working maybe on behalf of the city, and that's kind of your jurisdiction, if you get an impact study or a cost benefit report prepared for you, it should speak to your local impact at the city. And so a lot of times, a developer, a business may bring an impact report or a cost benefit report to you, and it was prepared maybe from the perspective of the state. And so you at the city are looking at these impact numbers at the state level, or revenues and costs relative to the state government, and it really just doesn't apply to you. And so the very first thing on a cost benefit report is you need to make sure that it focuses on your specific region. And so again, if you're at the state level, you want a state level impact report. If you're at a city, you want to see specifically what's happened for the city. If you're at the county, you want to know that this impact is representative of what's going to happen in the county. Sometimes maybe there's a metro region, you might want to do something at the MSA level, but for the majority of the clients that we work with, I think it's going to be down to that city level or maybe even county level of interest. And the next thing that we need to keep in mind as we think about these cost benefit reports that typically include the economic impact as a component of it, you need to remember that economic impact is not just one number. And actually, economic impact is going to be measured in 4 different ways. And so the idea behind economic impact is that anytime money changes hands, so whether it's a business purchasing inputs or supplies through its supply chain, and they spend money there, or if they spend money for employees, for workers, for labor, or even if the workers themselves then go on and spend some of their money, that is going to cause an economic, there's going to be some economic activity there, and we can measure that. And so, like I said, there are 4 different ways that economic impact is typically measured. I have the terminology that we generally use. I'll say that there are different models, there are different ways to phrase this, so it's definitely not standard, but we can talk about some of the other labels. So employment, that one's pretty simple. It's the jobs that are being created. That one, it's usually not too confusing. The second one here is called, I labeled it here, household earnings. That is the salary, that's the compensation that's paid to the workers. It'll generally include maybe the profits to the business owner as well. So household earnings is a little bit broader than just the salaries, let's say. But household earnings, you can think of it as salaries. You can think of it as labor income is sometimes a term that's used for that. And so that's just to be aware of there. The next measure of economic impact is economic output. And these last two, economic output and value added, is where things start to kind of get more confusing. Employment and earnings are generally easy to wrap your head around. You can think about what that looks like and sometimes even see those people. But when you start talking about economic output and then value added, that's when things get a little confusing. So economic output, another term for that is really just the spending impact. And so that is, economic output is the broadest measure of economic activity that there is. So if you think about economic output, you think of it as the revenues of the businesses involved in the impact. So for example, if it's a manufacturer that makes a product and they have revenues of $5 million, their revenue counts kind of toward this economic output. Then you also add to that, as you go back in that supply chain, the revenues of the businesses when the manufacturer purchases its supply. So if it spends $1 million on some sort of input, say it's one of the main supplies, it's spending $1 million, we're going to add that, because every time we're spending money, economic impact is getting captured. So it's the value of the goods and services being produced in the economy. Now, if you're thinking about this and you're adding up all of just the spending that's going on, you might think, well, that might overstate things, because you're counting the inputs that went into, so if it was $1 million of inputs that went into that manufacturer's product that they sold then for 5 million, you're kind of double counting some of that. And so that's why value added exists, and it really strips out some of that double counting of that spending. And so the point with all of this is that economic output is going to be your largest number. That's really just all of the spending that's happening in the economy. And then the value added is really where you can see kind of what's the actual net effect of this business. And if you're trying to compare it, for example, to the gross area product or the gross state product, or at the national level, the GDP, gross domestic product, you would want to be looking at the value added to see how much the value added contributes to that GDP. So it's that idea that we don't want to double count intermediate inputs into the whole process. And that gets down into the weeds a little bit. The question here in the last bullet says, how useful is economic output and value added? And I'll say, in our experience, it's really just more confusing than anything. And while you'll see it in the newspaper very often, it's going to have $5 billion economic impact, and what they're probably presenting there is economic output. That's $5 billion in economic output. It really doesn't tell you very much about it, other than it's some big number that seems impressive. For us, and for the typical project in the economic development sense, we would suggest you focus on the employment and the earnings, which are a little bit easier to understand, wrap your head around, and typically more instructive. So moving on to our kind of third piece here, we want to understand multipliers. And so we've touched on this in various ways as we've talked about the first two items. But multipliers, that's generally how economic impacts are being calculated. So a big part of these cost-benefit reports will be this economic impact component. And generally speaking, the economic impacts are calculated using multipliers. There's a number of different programs out there that can produce multipliers. So for example, you may be familiar with the RIMS-2 multipliers, which are provided by the Bureau of Economic Analysis. And that's kind of under the Federal Department of Commerce. So that's one source, that's a federal source that you can get multipliers. Another private company that provides multipliers is Implan. They have a whole model, and part of what you can get out of that is multipliers. You can do a little bit more than just multipliers with Implan, but certainly that's a component of what Implan does. And I'm aware of, and you may subscribe to EMSI or MC Data, and they in addition to a number of other things, they will have an economic impact component where you can see multipliers for economic impact. And so I don't have any strong suggestion in terms of oh, you have to use these, or another set of multipliers are no good, and that kind of thing. In general, you just want to understand what multipliers are doing. And so there's multipliers really for any type of impact. And so when I say any type of impact, I mean those 4 different sources of economic, how we're going to measure economic activity. So there's employment multipliers, there's earnings, household earnings multipliers, there's economic output multipliers, and value added multipliers. And so kind of putting any of those things together, you can estimate basically the other measures. So I'm going to use just an example here, which is kind of the most standard. I'm going to talk about a direct effect employment multiplier, and I'll give it for a specific industry, and I'll give it for a specific geographic area. So the idea with multipliers, they need to be industry specific. So they need to be representative of the industry for which the activity is. So if you have, in this case, let's say a furniture manufacturer, that multiplier is going to be different than if you had a new restaurant coming in. If you had a Chick-fil-A coming in, it would be a different multiplier to look at what the impact of that restaurant would be. Now, the other components here, not only are they industry specific, but they're also region specific. So as we see here, there's 2 different numbers in this for this furniture manufacturer. We have one for Dallas County, and that's 2.05. We'll talk about what that means in a second. And we see the statewide multiplier is 2.73. So the multipliers, again, are going to vary by industry and by region. So we need to make sure that we're getting the right piece there. Now, when we say, in this case, that what we're talking about is an employment multiplier, direct effect employment multiplier for Dallas County, this happens to be telling us that for every 1 direct job created by this furniture manufacturer, there will be 2.05 total jobs created in Dallas County. So that will mean that there's the 1 direct job, as well as 1.05 spin-off jobs, for a total of 2.05 in Dallas County. Now, if we look at the statewide multiplier, that's about 0.7 or so larger than the Dallas County multiplier. So that what that's telling us is that for every 1 direct job created in the state by this furniture manufacturer, there'd be 2.7 jobs created statewide. So now you need to keep in mind the way that this is presented, at least, that the Dallas County multiplier, the impact at the local level, is basically just a subset of what you see at the statewide. So that it's not like we're adding these together in any way. We're saying that statewide it's 2.7, specifically in Dallas it's 2 or 2.05. So that's how those multipliers work in that case. Now again, there's multipliers for all different types of impacts, so you could do a similar calculation or analysis for earnings and for some of the other attributes. Now I've been talking about this idea of multiplier activity, and this is kind of capturing the spin-off activity that happens that as spending occurs and it ripples through the economy, and some of that spending stays within the particular region. So if it's in Dallas County, how much, when that money gets respent in Dallas County, how many times does that turn over? And so how much additional impact does that actually generate? And so there's kind of 2 distinctions. When you might say spin-off, it could mean maybe just the indirect, or it could mean indirect and induced. And so the terminology for indirect really means the business to business spending. So if, again, we have a furniture manufacturer, they're spending money on their suppliers, and you follow all of the spending that goes back that supply chain, that is going to be the indirect activity. So as it ripples backward through the suppliers, the business to business spending, that's what we're capturing with indirect. The induced is really when we're talking about the employees getting a paycheck and spending some of that money within that county or that region specifically. So as an employee is working at the furniture manufacturing company and they get a paycheck and they go spend it at a restaurant or on groceries or even on housing and all of the different things that you buy, that's going to be capturing this induced effect. And so generally speaking, there's, as I said, there's kind of 2 different ways to do this. You could just do it with just very strictly focusing on the indirect impact. That's just business to business spending. Or probably more realistically, you want to capture what happens when those workers that are getting paid are going to spend their money in the community as well. And so that's going to be where you include the induced as well. So in my example, while it's not really stated, the 2.05 for Dallas County is the inclusive of the indirect and induced activity. And so that's just some terminology to be aware of out there as you might see the results broken out differently. Now, number 4, this is where I think for economic developers, this is where it really kind of comes together for them, is when you need to balance the public revenues versus public costs. So we have this idea that there's some economic impact, and that's going to translate into some additional tax revenue for government, for the local governments, and also maybe some costs. So we've talked about economic impact. That's definitely a part of what these reports will include, or a good report should include anyway. You've got the economic impact being laid out, and then now we need to translate that into, as I say, fiscal impacts, which are just the tax revenues and maybe some costs, if there's going to be some costs associated with the project. So on the tax revenue side, the most common things that you can think about, especially at the local level, are property taxes, potentially sales taxes. It's certainly in Texas, where we're located and where a lot of our clients are located, there's many cities have a local sales tax. Other communities across the country do as well, but sometimes you might see that it's a state level sales tax, and actually there is no local portion of the sales tax. But property tax is one of the most common funding sources for local government, so that's pretty much across the board. The other types of revenues that you might see at a local level would be maybe from a city. If the city owns some utilities, we might want to capture the revenue that's generated from providing those city-owned utilities. That might be things like water, wastewater, solid waste. In some cases, we've seen cities with an electric utility or even a gas utility. And then franchise fees. So for maybe the other utilities that the city doesn't provide, they might be charging franchise fees to utility providers that for the use of the right of ways. And so for, and it may not be significant depending on the type of business, but if you have a large electricity user and you have an electric franchise fee, this may be some significant revenue. So a lot of these things kind of depend as you're working on an actual project, but it's interesting to kind of make that full list of what you might want to look at. On the cost side, we want to think about things like the cost to provide public safety service, so police, fire, EMS, or education. Again, if we're thinking of this maybe even from the school district's perspective, we could get into that. And then one that I didn't list here, but you can already think about it based on the city-owned utilities. There's going to be a cost to provide those utilities. So just accounting for the revenue on utilities isn't going to be really fair or accurate. So we want to balance the cost of providing those utilities against that revenue. And so most of the cities that we work with, I would say that there's probably a little bit of a margin that they make on their utilities. They're kind of an enterprise fund, and they might actually have some transfers that go to the general fund because regularly there's a little bit of margin built into their utilities. Now that's not always the case. You could be breaking even. That's fairly common as well. Or in some cases it could just be operating at a little bit of a deficit. So capturing that is an important piece. And then this idea about trying to look at public safety or education, it's really this idea that as new business activity occurs in an area, or if you have new workers moving to an area, we can expect some increase in costs for that local government. And so we generally will, at least with respect to new workers, let's say that it was 100 new workers, we can think about where are those workers coming from. So let's say there's 100 new jobs being created in a community. Where are those workers coming from? They may, hopefully many of them already live in that city or that community, and now they can just work right down the street. There may be a portion of those 100 jobs filled by people who live nearby, and they're going to commute in to the community. And then the third category really is where they say, oh man, that looks like a great job, I want to live there, and they're going to someone might relocate, and a portion of the 100 jobs might be filled by people relocating and moving to the city. And so that's going to depend again on a number of different things: the type of position that's being hired, maybe the wages, kind of the commuting patterns, even, so to speak. So if you're in the Dallas Metroplex, there's a lot of kind of back and forth between where you live versus where you work in terms of the city. But in other areas, there may not be a large workforce or labor force kind of immediately outside of your area, and so those pieces all kind of depend on the specific community. And then finally, listed here too is just any one-time costs for infrastructure or other government expenditures that you're aware of. We can think about the incremental things as we're trying to there with the third bullet, but then the fourth bullet is like, well, what about the one-time kind of things that may occur as well? We want to make sure that those get reflected in this balance between the public revenues and the public costs. Now, the fifth thing here we want to make sure that these revenues and these impacts are detailed by jurisdiction. So meaning, is this a cost or a revenue to the city, and over time, so over a period of time. So first of all, we need to understand that the benefits, or even the costs, as I should say, the benefits and costs accrue over a period of time, and they're distributed. Those benefits and costs are distributed with varying intensity across different levels of government. So a cost-benefit report should really cover multiple years. Really, a one-year analysis won't tell the entire story. A lot of times there's maybe some investment phase, and then there's operations, or if there's some sort of initial ramp up in the investment, and so, or the ramp up in employment. So really looking at a 1-year snapshot or a levelized number isn't going to tell you the whole story. As I say here, economic development is a film strip, not just a snapshot or a photograph. So you really need to kind of get the full view of things, and taking just okay, there's the 1 year, one snapshot impact. That's not going to really tell the whole story. And then as you think about that, though, as you're going out, maybe 10 years is somewhat typical. You want to think about maybe present value and try to say, well, look, are we getting, and present value can help you say, like, are we getting all this revenue kind of up to the front, or is it kind of more back end weighted, or is it kind of over time? And so what does that mean? Like, if we think about, if it's $200,000 of net benefits over 10 years, what does that mean in today's dollars? And so if we were to discount that back to present value, is that 100,000 or is that 175,000? And so it could vary depending on the flow of those benefits and costs. And then this idea about being detailed by jurisdiction. We need to talk about state and local taxes are really the result of specific tax rates. So you might think, or a business might think, they send a single check to pay their property tax bill, but as everybody knows, it seems, that's going out to different jurisdictions. And so maybe the school district is very often the largest beneficiary there of the property tax bill, but the city and the county is getting a portion. Maybe there's a hospital district or a college district that's going to get a portion of that property tax. And you really need to break that out so that the city knows specifically what they're going to get from property taxes, rather than just saying, okay, yeah, it's about 2% property tax rate, and so this project's going to generate, X amount in property taxes. That's not as detailed as it really needs to be. And then just another example here with sales tax. So in Texas, it's 8.25% typically, almost everywhere. But obviously not all of that goes to the state. It's really 6.25% goes to the state. And then depending on where you are, the city might get 2%, or the city might get 1.5%, and the county gets 0.5%, or it really varies from place to place. So being able to kind of drill down on that, and basically not assuming that, oh yeah, there's 8.25%, percent sales tax, so we'll just throw that in there as a benefit that the company's going to bring, and that's not really accurate if you're not the one getting all of that. So next on my list here, number 6 is really just, are the inputs and other key assumptions available, and can you see what those things are? As we've been talking here, you can already hear all of the different assumptions that are going into one of these reports. There's a number of really just different inputs and key assumptions that are going to be done. So as I think about this, I break it up kind of in 3 different ways. So first of all, you have the project attributes. These are things like the jobs, the capital investment, the salaries paid. Those are things that you're going to get, or you're going to obtain from the new business or the new employer, to be able to tell you to get a sense of what do they plan to do. So that's the project part. And then that's the project attributes, that obviously changes for every single project. Then you have the tax structure, and really that it it might change once a year if the tax rates change and that sort of thing. But generally speaking, once you get that modeled out correctly, the tax structure is more or less kind of something there that stays as a framework for you to run these different project attributes through. So the tax structure, you're thinking about, how is property taxed? What is taxed? Do they tax inventories in this community or not? That kind of stuff. And then the key assumptions. So that's when you get into everything else. When we think about, well, are people going to relocate here? What are the commuting patterns like? What are the spending patterns like? Do they spend a lot of their earnings here, let's say? As you think about, again, if we're going over multiple years and we want to have that film strip, we need to think about, does the property increase in value over time? Like real property may appreciate, but business personal property, if you have that as taxable, that may depreciate in value over time. And so those are all kind of critical into driving once you get down to these net results. And so, you need to, number one, make some decisions on those assumptions, but then also have those available so that they can be reviewed if necessary. And like I say here, are all of these correct and reasonable? So a lot of times you'll be dealing with information that really you can't be certain that they're correct. You can be certain, for example, that the property tax rate is correct for today, that it's the current tax rate, let's say. But is it correct is somewhat times difficult, but reasonable. You can get in and really kind of get some input from some of the stakeholders in that case, and maybe even run through some different iterations and do that scenario analysis to be able to see how certain assumptions would affect things if you are uncertain, or if there is some concern about certain inputs. And then number 7, I think the biggest one, and particularly obviously for economic developers, is to make sure that incentives are analyzed. And so incentives, it's just a kind of a pretty broad term. And even within that, I'm going to try to simplify it a good bit. But for example, we generally break it out, at least in our minds, as you could have one type of incentive where you're just going to rebate or abate kind of a stream of revenue that's coming into a particular city or a county or whichever entity. So if that's tied to a specific revenue, we want to make sure that kind of gets reflected in that net fiscal benefit. So as we kind of detail by each jurisdiction, we say, okay, these are the benefits, these are the costs, and we want to say, okay, but we're going to have a tax abatement where the company doesn't have to pay necessarily, maybe there's a 50% tax abatement, and we want to see how that affects those net benefits. Obviously, a tax abatement that's going to lower your property tax collections, and your net benefits there will then be affected by that. So that's one. And tax abatement, whether it's property tax abatement or you're talking about a sales tax rebate or other things, when it's tied to a specific revenue based on their specific activity, that's one that you want to think about there. Now, the other type of incentive that we kind of just generally think about, so if we break these down into the broadest terms possible, we think of a non-tax incentive. So that's not really tied to a specific revenue source. And so in that case, maybe it's an infrastructure grant, or if it's a piece of land that you're going to offer either at a discounted rate, you could kind of say, well, it's really worth $500,000. We're going to sell it to you for $200,000. So this, incentive might be thought of as the difference there of $300,000. Or again, if you're just giving them the piece of land, well, then there's the value of the land might be thought of as the incentive. And so the way that we would suggest that economic developers kind of think about this is to really put it into this framework as an investment. So the incentive is equivalent to your investment. The economic development organization invests in this by the $300,000, let's say, and the new fiscal benefit, that net fiscal benefit, is the return on the investment. So there's we're looking at probably over 10 years or so. We can calculate a rate of return on that investment, and we can calculate a payback period to see, by year 3, let's say, the city will have collected enough in net new fiscal taxes to cover the value of that incentive or investment. And so that would be that 3-year payback period, let's say. So as we I'll show you an example of kind of a 1-page summary report here in this case, it was a plywood manufacturer in a particular city. This is our city of Cowtown in Texas. For Project Armadillo. But we can see we're really hitting on a lot of these 7 things that we just talked about. So I can kind of go into detail and show you exactly where each one of these things comes through. So for example, if we remember going all the way back to recap all 7 of these things, we've got number 1, we need to focus on your region. So if you're the EDC organization for Cowtown, you want to focus on your region. And so this needs to be an impact analysis relating to your city. It can't be a state level impact report. So this is already hitting that one. Now, we want to talk about economic impact, and we remember that isn't just one number. It's actually 4 different things in general. 2 of them are honestly probably beyond comprehension for most folks and don't need to be really thrown in here. We think that job creation or employment and salaries or earnings are probably the most instructive, and so that's what we've got here as some of our economic impacts that we calculate. We talked about multipliers, and you just want to think about, is this multiplier reasonable? What did they, what was the industry? What was the geography, and all of those different things associated with multipliers. If we kind of just do some math there, we can see that if we divide, so we have 69 total jobs and we have 50 direct. So if we kind of do the math on that, it's a 1.38 multiplier. So that's certainly modest. I mean, it's definitely not, what some folks would do, especially at a city level, depending on how big the city is and so forth. 1.38, it's actually fairly strong for a city, but if you're talking about at the state level, it might be more modest. The 4th thing, we want to balance those public revenues and those public costs, and so that's this on the lower half of the 1-page report here. We go into that detail for the city. So we list out the benefits. Those are coming from the sales taxes, the property taxes, and different sources of revenue that we see there. So the benefits are subtotaling about $320,000. Then on the cost side, again, from the perspective of the government, of the city, what are the costs of utility services? What are the cost of government services and so forth? We go to looking at the jurisdiction, the impact for other jurisdictions. We want to see maybe what's happening for the county or for the school district. And so we see that the impacts are estimated by jurisdiction and over time. So if we're focusing on the city, maybe that's our point of focus. But then by jurisdiction, we can see what's happening for the county, the school district, and some of the other taxing entities. And these are the net benefits over 10 years. So we're looking at this over that 10-year time frame. Number 6, we've got about inputs and key assumptions are available. And in our case, we have a separate detailed report where you can see a lot of that information and dig in on all of those. When we're trying to keep it concise on 1 page, it's kind of difficult to do that. And then number 7, we go back to the bottom half of our page here. We can see our incentives analyzed here. In this case, we had a $75,000 incentive. Again, if we think of that incentive as the investment, we compare that to the net benefits that are shown right there to the left of it, about $165,000. That's our return on investment. And we were able to calculate the rate of return being about 22%. The average annual rate of return is 22%. And your payback period is looking at just under 5 years. So by 5 years, the city will have collected enough, over $75,000, to cover the value of that incentive. And so really that's kind of how we see a lot of this coming together, and I hope the discussion here was helpful to everyone in looking at some of this terminology. And as you see other reports out there, hopefully it'll help you kind of connect back to understand more of exactly what they mean. In general, I would suggest that economic developers, use a consistent framework. I think a lot of the times you'll have businesses or developers bring reports to you, and they're using whatever, maybe they used a different consultant or some other format, and it can be hard to wrap your head around exactly what they're showing or how it was calculated. And you have a lot of these types of questions that we discussed today. But again, I'm going to wrap it up here, and if we'll turn it over to questions. My contact information is here. We have an online model that basically generates reports that try to hit on each of these key components for a cost benefit report. It's an online tool. You can check it out at theimpactdashboard.com. But like I said, we also do individual reports. If there's anything that you have, if you just want to ask about a specific project, we can certainly talk, and I'm available to do that. Victor, are there any questions that I might want to answer here, or?
And Paul, thank you very much, by the way. This is Ron. Before I turn over to Victor for questions, I just want to let everyone know that it's on the conference. We will have this recorded. We'll also post it on the Golden Shovel website if anybody would like to access it there. And lastly, if you have any direct questions, I would highly recommend contacting Paul. So obviously very knowledgeable and a resource that you can use. So with that, I'll turn it over to questions. If there are none, we can close up the session. But thank you again, Paul. What a great resource to have.
Great, thanks.
Thank you, Ron. Thank you, Paul. So we will open it up for questions now. Please use your questions panel that is available in your GoToWebinar control panel. Paul, we have a question here. And it says, is this technique suitable for a small business owner?
Yeah, it would be. I mean, obviously the impacts are going to be relative to, are going to be kind of proportional to what you're doing. But you know, a typical small business owner, you know, if they have a few employees, they have some property. I mean, all of those things are going to typically generate some benefits for the community. Now, we have clients that will use this model for very large projects, and honestly for very small projects. They might just have a you know, like a machine shop owner in the community that needs a new piece of equipment, and the EDC is considering kind of helping them out with helping them acquire a $10,000 piece of equipment, and kind of running their numbers through there. You know, they can kind of see that this is a good business that has some real value for the community, and so it makes sense to help out in that case. So it could certainly work really on any size project, this approach.
Okay, thank you. We have another question here. Could this be used as a reverse analysis in the case of possibly losing a company?
Yeah, so, and there'd be some assumptions you want to make that are a little bit unique to that, but right. So very common thing for some of our clients would be that retention project, or retention and expansion even. But really, if you're just thinking about a retention project, you might want to kind of quantify the value of this business. So they have a certain amount of property currently. That would be kind of comparable to the idea that this new business is coming in, they're going to make an investment, but you would start with, okay, well, they currently have this amount of property on the tax rolls, they have this many employees, and you could just estimate, and you wouldn't get into things like, oh, people moving to the community, they're already there. So we don't want to get into some of those net impact things that we did if it were a brand new company. So there's just a few tweaks that you would make, but essentially you can quantify the property taxes that business is currently paying, and you know, if they stuck around, would continue to pay, the number of employees that they have, and if they stuck around, would continue to employ and capture those benefits, and really value kind of on the other side of this, the loss that the community might face if that company were to either relocate or, you know, completely go out of business or something.
All right. Another question here. What is the cost of a study for an industry coming to your community?
Sure. For just a single new business coming to a community, and if we were to do the report for you, it would be somewhere between maybe $1,000 and $1,500, just depending on kind of the specifics, and if there were some unique things there. There's a lot of things that can kind of complicate things, but on the more run-of-the-mill, that would be the range.
Okay. Another question here. What's the average cost in working with a specific project, and who will be the initiator, the city or the developer?
From our perspective, it's usually where our clients are almost entirely public organizations, so the city or the ED organization or the state or a county organization for economic development. And so that's the way it typically happens. From time to time, we get called by a business just because we're kind of so specialized. Folks are looking for what we do, and businesses would find us and would ask us to prepare a report. And so in those cases, it's basically the same report either way. But we would prepare the report, and then again, it's always the audience for us is always going to be that economic developer or the public officials there in the community that are trying to understand the impact of the business. So it's really the majority of our work comes from actual economic developers on the ground, not necessarily the developers, the private developers or businesses.
Okay. One of our attendees is asking, can you define again value added from the four main categories of cost benefit?
Yeah, so you have, it's basically economic output less or subtracting out any of the intermediate inputs. So economic output is double counting all of those intermediate inputs that get used to produce the next product. So if you're a furniture manufacturer, you're buying wood, economic impact is going to count the revenue to that wood supplier, and it's going to count the revenue to the furniture seller when they sell that finished piece of furniture. Value added, you want to strip out the fact that you already accounted for. So basically you're taking economic output and taking out the intermediate inputs, that basically the value of the wood there, and not overstating the overall, and just looking at the value that the furniture manufacturer added in that particular stage. So maybe I can send you the link, Victor, if you want. This is a definitely confusing topic. We have I think it's two different blogs that go into detail on this issue of value added, GDP, and economic output, and kind of how to wrap your head around those.
Got it. Thank you, Paul. One more question. Where do your public costs come from? Are they provided by the end user, or do you have certain model assumptions?
Sure. Yeah. So the way that we normally do this, and we get input from the client, if the city finance department or county finance folks or state finance folks want to get in and offer input on the model, we'll certainly take it, and that's usually going to just make it that much better. But our general approach will be to take a look at the city's budget, or so if let's say that we're trying to estimate the public cost for a city, and we'll look at the costs that they're currently spending right now. So we look at the budget, we look at their expenditures, what are they spending money on, and we try to come up. So number one, we split that out. We try to split out, a portion of those costs are going to be for businesses, and a portion of that is going to be providing services to households. Majority is typically for households. You can look at some different ratios to try to figure out in a particular city whether what that ratio is, because communities are different. As you know, there might be a bedroom community where there's not a lot of business, or it might be some place where there's a lot of business and no one actually lives, or not very many. And so we try to make that split, and then we try to estimate then how much does the community currently spend to provide services to households on a per household basis, and then how much does the city spend currently to provide services to businesses on a per employee basis. And so we use that metric to kind of then back into a marginal cost based on the different types of expenditures that we're talking about. So police, fire, EMS, we expect those to be a little bit higher in terms of the relative average cost, but things like general government and different things, it's probably less sensitive to a new household moving to the community. So we kind of try to come up with a good marginal estimate, a marginal cost estimate for each one of those things. So then if a particular project that we assume is going to have 30 households move to the area, we can apply that marginal cost to provide services to 30 new households to that 30 number. And then the same thing, if they have 100 workers, then we can look at it from the marginal cost to provide services to the new business. And so that's generally how it's done. We have basically, when we put a model together for a client, we have a user guide that walks through exactly how we did that. And that's usually one of our points of discussion as we're setting things up. And like I say, getting the finance folks or city manager or other people in on those conversations is helpful, particularly if they're going to be the ones kind of in the audience as you present projects and so forth.
Okay, thank you. It seems like some of our attendants would like to connect with you. They are wondering if you will be at the ICSC event. I believe that will be in Vegas.
No, I am not going to be there. I don't think, I'm trying to think we will, I don't think we'll be there, any of us, but I'm trying to think that we're actually, if we're we're doing some events in Texas, I'll say. We're doing some economic development best practice events that you can RSVP for. We're kind of going around Texas, hitting up a bunch of different communities. Next week we'll be in Tyler, kind of East Texas. And then we have some dates in Houston and Harlingen and Levelland. Then as well, Georgetown, Texas tomorrow, and then a couple other Central Texas ones later in May. So there's some places there that can connect. I think we'll have some representatives at the TEDC summer mid-year conference, and we'll be at IEDC in the fall. But if you want to reach out, we can connect by phone or email. And I'm sorry, I'm going to miss out on all the fun in Vegas.
Okay, sounds great, Paul. One last question. Are the costs just the cost of abatements?
No, well, no. It's the costs are these, as we've talked about, these marginal costs to provide services. So you can think of tax abatement as a cost, and we definitely want to pull that out of the revenue. But then there's also this idea of providing services like police services, for example, or even the case of like utility revenue. We want to balance that with the cost of providing utilities. So it's actually the other city departments of things that they actually are going to be providing services on.
Thank you, Paul.
All right.
And
thank you.
It seems like we don't have any other questions. So thank you everyone for your time, and special thanks to Paul for putting this presentation together for us. We will have the slides and a recording of the session available for you. So if you would like a copy, please email me at vperez, that's VPEREZ, at goldenshovelagency.com. And I'll make sure to provide you with access to the slides and the recording. We look forward to our next webinar, and invitations will go out soon. Once again, thank you everyone, and have a great day.
Right. Thanks everyone.
Thank you, Paul. Bye.